Hi, this is Professor Gold again. This will be the last video for Module 1, and this will be an overview of Chapter 1 of our textbook. In the previous video, we kind of touched on, what finance is and, how complicated valuing stuff can be. In this chapter, there's a couple of key things that you need to take away from reading the chapter. First of all, what are the three types of business organizations that can be formed? Well, they're listed here. One is called a sole proprietorship, the other are partnerships, and the third one is a corporation. I'm going to just summarize each of these briefly for you on the following slides. A sole proprietorship is by far the most popular form of business formation because it's easiest to create and it's the least expensive to create. A sole proprietorship is essentially a single individual that owns the entire business and is fully responsible for the firm's profits and all of its debts. There is no protection, so if a creditor comes after your business, they can come right after you personally, but it is by far the most popular form of business formation. Over 70% of all businesses in the United States are sole proprietorships. The typical sources of funding for sole proprietorships comes from sometimes borrowing from a bank, the three F's, which are friends, family members, and of course fools, and sometimes the use of credit, personal credit, credit cards, savings, and things like that can be used by sole proprietors as well. As I said, there are some advantages. It's easy to start, but there are, of course, some very, very large disadvantages, most notably that you're personally liable for any of the business's debts. A partnership comes in two forms. One is a general partnership, and this is when two or more people get together. So a partnership can have 29 people in it or 2 people in it. And a partnership has typically general partners and limited partners. General partners are responsible for managing the day-to-day operations of the business. Limited partners are the people that basically fund the business, that provide some sort of funding mechanism for the business. So as a consequence, general partners are perhaps the company founder, doesn't have a lot of money, puts together a partnership with some people that do have money, and a partnership is born. The general partner may have some sort of expertise or the idea that was used to create the business, and the limited partners may have some other expertise, most notably financing or access to funds or money, capital. The general partner has full liability, whereas the limited partner has limited liability in terms of debts owed by the business. A corporation, and there's two types that we're going to cover, a C corporation or an S corporation, is viewed as an independent entity in the eyes of the government. A corporation has its own tax ID number, a corporation has its own bank accounts, its own persona, so to speak. It's a legal entity, and that's a big distinction between a partnership and, of course, a sole proprietorship. The two types of corporations primarily that exist are a C corporation and an S corporation. A main difference there is an S corporation is a corporation that has no tax liability at the end of the year. So any profits that are earned by an S corporation, those profits are transferred to the primary business owner of that corporation. So for example, my corporation in New York is an S corporation. So each year, whatever money my business makes, I then have to report on my personal income tax return. A C corporation is what most large companies you know about are structured as. For example, General Electric or Yahoo or Microsoft. All of those companies are what's known as a C corporation. A C corporation has tax liability. So at the end of the year, whatever the profits are of that corporation, the corporation itself has to pay taxes. One of the great advantages of a corporate structure over the other two that we've discussed is greater access to capital, primarily through the capital markets, which we'll cover later on in other chapters. The two primary capital markets that you should be aware of just at this point in the class are, of course, the stock market and the bond market. The stock market is where corporations go and get capital in exchange for ownership in the corporation. The bond market is where corporations go to get access to capital in exchange for a rate of interest that they have to pay to those lenders. So in those particular instances, a corporation has a much wider array of access to capital than, say, a sole proprietor might. A limited liability corporation is a third type, and it combines the tax benefits of a partnership, which has no double taxation, along with the limited liability benefits of a corporation. So the owner's liability is only limited to what they invest. So if you put $100 in to start up your corporation and the corporation goes under, well, you're going to probably lose that $100, but you're not going to have to pay back the debts that the corporation may have incurred along that way to other vendors. Limited liability corporations have become increasingly popular. You should know that they're a bit more costly to start up, and they have a limited lifespan as well. On this particular graph, you can see on the left-hand column, business form, the different types of forms of business that we've discussed. And then along the top row, you'll see different criteria that's set for each one. You should definitely review this table at some point in the future by pausing the video or looking it up in the textbook, because there are several questions on the first exam related to being able to differentiate between a partnership and a corporation, or a sole proprietorship and a limited liability company, and so on and so forth. The second thing in Chapter 1 that's important is the structure of finance and how the finance function fits into a large corporation or traditional corporate structure. So here you see the board of directors, which is a bunch of people that are elected by the common shareholders of the corporation. The board of directors has the responsibility, among other things, of hiring and firing the executives of the company, the C-level executives. So the CEO, the chief financial officer, the chief marketing officer, the chief operating officer, all those C-level executives are hired and fired by the board of directors. So if you're a shareholder, a common shareholder, common stock shareholder in the company, and you don't like the job the CEO is doing, your two recourses are to either sell the stock and no longer own it, or to try to vote in different board members onto the board of directors who will replace the current CEO with a different one. As you can see, in most traditional corporations, the CFO reports to the chief executive officer. It's not always that way. Some CFOs are more on a level playing field with the CEO. And over the past 40 years, you should just know that the role of the CFO has become increasingly important within corporations, largely due to the fact that globalization has accelerated. So as globalization has increased at a faster and faster pace, the responsibilities that fall under the domain of finance become increasingly important. For example, every company has a limited amount of capital. How you manage that capital across the entire world becomes much more challenging than how you might have managed that capital within one particular country. In addition, because most companies now do business in many parts of the world, they're dealing with many different currencies. So foreign exchange becomes an issue as well, all falling under the domain of the CFO. Ethics is covered in this chapter, and ethics is really something you need to take an entire course on, because business ethics is important, but especially within the realm of the world of finance, it's critical. There is a certain trust that is bestowed upon financial experts and people that practice finance and accounting, where the public is relying on folks who are involved in those facets of business to be the gatekeepers of honest and transparent information. However, of course, in the real world, when there's large amounts of money involved, people tend to justify bad behavior in the hope of trying to gain access to all of that potential money, and this leads to unethical conduct. Of course, there's been a wave of ethics scandals rather over the past 30 years, and we'll discuss those in more detail later on in the semester. Sarbanes-Oxley Act was a piece of legislation that was passed after a wave of ethics scandals back in the early 2000s with Enron and WorldCom and all of those companies, like 5 or 6 companies that had accounting scandals and committed accounting fraud. So this law was passed in an attempt to try to mitigate those occurrences from happening again. There are 5 basic principles involved in the field of finance, and I'm just going to go over them real quickly here. The first one is that money has a time value. So simply put, the time value of money concept is that a dollar received today is worth more than a dollar received in the future. The reason for that is you can take the dollar today and invest it and begin earning interest on that money. So in 1 year from now, that $1 will be worth more than had you waited a year to receive that dollar. This is a critical element of the field of finance, and we'll go into the time value of money concept in great detail in later chapters. There is, of course, a risk-return trade-off, and I'll show you on this slide here what I mean by that. Basically, the greater the expected return, what you think you should earn on an investment that you make, the greater the risk that you're taking. There is a direct correlation, as you can see through the upward sloping line. That means that there's a positive relationship between these two variables. The higher the expected return, the greater the risk. The greater the risk, the higher the expected return. The lower the risk, the lower the expected return. That's why returns on savings accounts, which are risk-free, are so low today, whereas returns on investments in startup companies is so high, and therefore the returns are potentially very high as well. Cash flows are the source of value for companies. That's principle 3. Cash flow is an accounting concept that is critical to this course, but accounting in general, and we'll cover that in the next couple of chapters. But basically, when you're doing financial calculations, you're going to make guesses and forecasts about future cash flows that a business might generate, profits that a company might generate in cash. And that is a way for us to begin valuing how much a company might be worth today. Is it possible for a firm to report profits but have no cash? The answer to that, of course, is yes. There's a huge difference between profit and cash, and we'll talk about that during the accounting chapters. Principle 4 is market prices reflect information. This basically means that when something happens in the world that affects an investment, a stock, let's say, that information is adjusted relatively quickly in the financial market. So when you look at the stock price of a company, the assumption here in finance is that that stock price reflects all available information out in the public domain. The 5th principle is individuals respond to incentives. So this you probably understand, and this is really the model used in the United States. If someone says to you, if you produce X number of widgets, which is just a generic term for a product in business, over the next week, you will get a bonus of X. And a lot of people will respond to that. They'll work extra hard to try to produce that quota of widgets in the hope of getting some sort of financial gain out of it. Of course, there are many complications in this particular domain. If you incentivize executives of corporations to do things that will lead to them getting compensated significantly, well, they might start to consider bending ethical boundaries in order to get to